everyone. Welcome to At Home with Hayley. I am, of course, Hayley Andrews. I can see you coming through. If you could pop in the chat box that you can hear me loud and clear, that would be perfect. And we'll get started with today's show. Come on, don't be shy. Can you hear me? Morning, Felix. Fantastic. Felix from Hong Kong. Let us know where you're dialing in from. This is an international webinar, and we do have people that dial in from all over the world. So good morning, everyone. I can see everybody coming through now, and confirmation that you can hear me loud and clear. So we'll get started with today's show. So today's show is episode 59. Can you believe it? So next month is our 60th birthday. So we will be doing something super exciting for that, and we'll have a real treat for you as well. So this is a show where we talk about all things property. We bring on experts within their fields to talk about different elements of the property industry and their expertise. And of course, we answer all of your questions and give you a UK market update as well on a monthly basis. It's always the first Friday of every month, and it's always at 9 o'clock UK time. So what we will do is we're going to jump into our first guest. After the first guest, we'll go through some question and answers. We've got some updates for you as well, and some exciting news to share with you also. But we're going to get on with the show. And I'm going to introduce our very, very, very special guest. We haven't had him on the show for a while, but the one and only Nick Burns. Nick, are you there?
I am. Hello. Good morning, everybody.
Good morning.
Thank you for the very kind introduction, as always, Hayley. Very kind. Good to be back.
Okay. I'll pay you later. Or you can pay me later.
Yeah, that's it.
Pay
Yeah.
you.
You can
That's
if you
not
want.
exactly how it works, is it? Brilliant. So great to have you on the show again. I can't believe it's been 6 months since you were last on.
Is that right?
It's a long time, isn't it? So
I think it's really impressive as well that your 59th show. I think it's really good. Really very good.
Isn't it? Well, I mean, it's very good considering we were supposed to be 12 weeks. And the whole reason it's called At Home with Hayley is because it was during the first lockdown. And that's really what it was going to be for. But it's just continued. So
doing something right.
We must be doing something right. So as long as we've got people dialing in and we've got people that are engaged with what we're doing, we'll continue. It's forever free and informational. So yes, we're happy to be celebrating our 60th birthday. It's probably the only 60th birthday I'll ever be happy about celebrating. Right, okay, so while I load your slides, majority of the people I can see coming through will actually know you, but there will be some of those that are listening in that don't know who the wonderful Nick Burns is. So do you want to give a quick introduction of who you are and what you're going to be talking to the audience today about?
Absolutely, yeah. So hello to those names that I recognise and those people that I recognise, but to those that don't know me, I'm Nick Burns, and I run a company called Lighthouse FX, and we're foreign exchange specialists. So we help the international investors for exchanging currencies to buy the property in the UK at bank beating exchange rates, but there's a number of other things that we do. But yeah, I'm here today to speak about the sort of economy, and we're going to tie that in with the pound. Some of the stuff that has been going on. Obviously, there's quite a lot going on at the moment, as there has been for the last few years, particularly. So quite a lot to talk about, quite a lot to cover. And yeah, I'm going to sort of try and do my best to summarise things and what to look out for moving forward, really.
Fantastic. So while you're actually a currency broker, I actually love your market updates. So I've got my pen ready, a YFE pen, of course. So no pressure, but make sure you deliver.
Well, I'll do my best. Can't
Brilliant.
promise.
So I'm going to jump off camera. I'm here in the background if you need me. For those that are listening in, if you have any questions for Nick throughout the slot, just pop them in the chat box. If you have any general questions as well, also pop them in the chat box, and we will get to a question and answers at the end of your slot. So over to you, Nicholas.
Yeah, absolutely. Thank you very much. Yeah. So, and likewise as well, I know I'm guilty sometimes of speaking too quickly. So if that's the case, feel free to, tell me to slow down on the chat or whatever. But yeah. So what is Lighthouse FX? So again, we specialize in high value cross currency payments. So when you're selling your Aussie dollar to buy the pound to buy your house, that's where we come in. So we offer bank beating exchange rates, about 1% cheaper on the value of the trade versus your usual sort of high street banks. But it's the sort of personalised service and support that we specialise in. And we help clients to execute trades at most favourable exchange rates. I'll come on to how volatile the exchange rates are at the moment and have been over the past little while. But that's really where we can help you guys out quite a lot. And honestly, a lot of the sort of particularly new international investors aren't aware of how much currency fluctuation impacts their investment and their profitability. And we've got a number of ways that we can help you with that. I'm not going to talk too much about currency and what we do today because I want to keep it pretty much an overview of the economy and sort of some of the stuff that's going on and could be going on in the future. But of course, feel free if you want to have a chat about currency afterwards. So UK economy, right? So back in the last year, so broadly speaking, there's a really wild recession is expected in the UK, or had been expected in the UK. We got some slightly positive news at the back end of last year in that we narrowly avoided, and when I say narrowly, I mean 0% growth and 0% contraction. So a recession, or a technical recession, is, depending whether you listen to Joe Biden or not, but is usually defined as 2 consecutive quarters of economic contraction, a shrinkage of GDP, gross domestic product. And we had a very slight dip in GDP over the third quarter of last year, but 0% in the fourth quarter. Could be revised later down the line, but technically at the moment we avoided recession, and so that's a positive for the UK. However, our growth outlook for the next year and into 2024, first half of 2024, is very, very weak. So we're expected to basically trim the line of growth / contraction and recession. So we're going to be skating on ice, according to forecasts at the moment, over the next year or so. And the worst growth outlook, according to the IMF and multiple analysts, of the G10, excluding Russia. So it's the 10 most developed nations in the world, except Russia. Obviously, Russia's got their own issues going on. Don't need to go into that too much, I'm sure. So the Bank of England previously predicted the longest recession on record. So they predicted 7 consecutive quarters of economic contraction. That was about 6 months ago, perhaps a little bit more. But they've since revised their estimates, as I say, to sort of suggest that we're going to be skating on this balance beam for a little while. Data recently, though, so from February, so the UK manufacturing and services sector, they're kind of early indicators. This set of data that I'm talking about here is the Purchasing Managers Index. So this is basically how many orders the manufacturing and services sector have received, and that shot up in February quite dramatically. So that's a really positive sign for the future, and a sort of unexpected surprise, I should say. I should stress as well. Broadly, unemployment remains around record lows. So with 3.7% during the back end of last year, the fourth quarter, so the final 3 months of last year. And that's a positive thing, of course. More people in work, the more productive the economy tends to be, broadly speaking. And inflation, now I'm going to come on to inflation a little bit later. We're going to hone in on that because that's quite a big one. But inflation slipped from an annualized 8.8% in January to 9.2%. From 9.2% to 8.8%. So that's a good thing. Obviously, ridiculously high. There's most countries across the world are facing similar issues. There's obviously a lot going on as the world's come out of this pandemic, and of course the Ukraine, Russia situation has pushed up prices. Again, I'll come on to this a little bit more later. But inflation is what's really driving, particularly currency markets, because of the implications for central bank policy. And again, I'll hone in on this in a little bit. But central banks around the world broadly are raising interest rates to stem inflation, which is potentially good, potentially bad, has good and bad connotations. Typically, though, a higher interest rate is bad for a domestic economy because it makes lending more expensive and more difficult. It means that people have less money in their pocket to spend. And that's the idea. You raise interest rates so people spend less, thus bringing inflation down. So that's the kind of rationale behind it. And we've got this Brexit breakthrough over the last couple of days, or last week. So that's a bit of excitement. Many people, myself included, have become very tired of Brexit. We're tired of hearing about it, but there seems to be a deal on the table that may well be pushed through. So we've still got this horrible Northern Ireland border. So this is more for the international guys. So when we left the EU, we made the decision to leave in 2016, but eventually left back in 2019 officially. We had this. We've got Northern Ireland, which is part of the UK, and mainland Ireland sharing a land border. But obviously, there's the sea, the Irish Sea in between, and there's been this ongoing issue where goods travelling to and from Northern Ireland, which is part of the UK, and mainland UK have been subject to checks, the EU checks, basically to ensure that everyone's paying their tax and that the goods are tariff free and et cetera, et cetera. It seems that there may be a deal on the table that would ease that burden, thus making the transit of goods much easier and much simpler. So again, that's potentially quite a good thing for the UK. But we've been here before. We've seen deals come and go, and they've been shot down. Both sides of the argument, pro-Brexit, anti-Brexit, Remain and Brexit, they're very polarised in their sides. And it's a real juggling act to keep everybody happy. So that's why we've seen these deals break down previously. But bit of positivity at the moment. The pound actually hasn't reacted too tough on it because I think there's much scepticism. But we'll see. Ones follow. So inflation. So the main gauge of inflation, the main sort of indicator, the statistic that drives, that gives people like me the indication of where inflation is called the Consumer Price Index. It's a gauge of the value of a basket of everyday goods. So stuff like, a packet of mints, apples, chocolate bar, pint of milk, stuff like that, stuff that you'd buy every day. And again, in January, it was at 8.8%. So prices, the price of a basket of everyday goods was 8.8% higher in January of this year compared to January of last year. Inflation peaked over 10% a little while ago. So there is this suggestion that inflation is peaking and potentially coming back down. But there's this, the question is, how sticky is this inflation? And, we've got obviously issues in Ukraine lingering, much going on. How long is inflation going to last? The Bank of England's target is 2% inflation. That's where they say that's the kind of most beneficial level for the economy, for a productive economy. And so obviously we're way above that. And this is similar, in the States, they're seeing similar levels, although a little bit lower at the moment. It's dropped a little bit lower, but similar levels across the world, really, broadly speaking. So we're not alone in that. The conflict in Ukraine. So how has that impacted financial markets and the economy? Well, I'm sure I'm saying a lot of stuff that people probably already know, but broadly speaking, cost of food, fuel, commodities, everything's gone through the roof, and still remains elevated to this day. I'm not a war expert or anything like that, but it doesn't look like that's going to go away anytime soon. And of course, there's risk associated with that. I'll leave it there. There's quite a lot to be said about that. However, the price of fuel is dropping, and that was reflected recently by the energy regulators in the UK, dropping the price cap on the amount of household bills. So from April, it's going to be reduced from the current £4,279 a year to £3,280. And that's expected to, assuming the cost of wholesale gas, etc., keeps falling, that potentially should keep falling as well. And that, of course, is an inflationary issue. So if everybody's paying more to heat their house, to cook their food, whatever it is, or less, that's an inflationary or deflationary reading. So that's a good thing. That should, in theory, bring inflation down in the near term. The main issue, see, if we had inflation at 8.8%, but people's wages were growing at 9%, it wouldn't be an issue because everyone's earning more money, things are costing more, but they can afford it. However, wage growth has been continually outpaced by inflation over the last couple of years. So wage growth is up at 6.7% at the end of last year, which is a really strong figure. Traditionally, it's nowhere near that. We'd typically look at around about 2-3% would be normal. But at the moment, 6.7%, but still a far cry from the 8.8% January inflation reading. So you can see, everyone's getting relatively poorer. People's pockets have had the hardest hit on record, essentially, because of the difference between inflation and wage growth. Now, there's a bit more to say on wage growth because we've got a number of public sector industries, teachers, solicitors, postmen, binmen, all this kind of stuff. Lots of people and train drivers again striking in order to get more pay. And I believe the train drivers is one that's close to my heart because yes, I have to travel on the darn things quite regularly. But the train drivers, the average salary is about 60 grand, which is almost double the national average wage. They're insisting on a 12%. I believe they refused an 8% wage rise, and they're after about 12%. So we've got a number of these different industries. My point is, a number of these different public sector industries pushing for these really high wage hikes. Now, this is, again, a balancing act. So that would push up wage growth overall, right? Which on the grand scheme of things looks quite good. However, if more people are getting paid more, they're spending more, which drives up inflation. So it's not quite a clear-cut thing. It is a bit of a double-edged sword. So one to follow. And so, again, you'll find that the government will be less than keen to offer everyone what they're after. Okay, so Bank of England. So, as I said, the Bank of England's task really is to make sure that everyone, that the economy is working. And again, they're playing this balancing act between bringing down inflation, but without tightening monetary policy too far. So if they raise interest rates, let's say, they took a shock decision. I mean, it won't happen, but just for an example, let's say they raised their base benchmark interest rate to 10%. It would mean that everybody, lending is really, really difficult. People it's obstructive to growth because businesses can't borrow to employ more people, or at least it's much more costly. And so that's a negative thing really for an economy. If interest rates and policy is too tight, it's bad. It's restrictive. However, of course, inflation being as it is also problematic. So they've got this kind of balancing act. Now, the higher inflation goes, the higher we would expect the benchmark interest rate to go. So currently, the Bank of England have done, I believe it's 8 consecutive interest rate hikes over the last year or so. Benchmark stands at 4% at the moment. We're expecting market consensus at the moment is for another 50 basis points. So it looks likely that the rate will peak at around about 4.5% in the months to come. However, again, what the Bank of England have stressed is that they are going to be data dependent. What that means is they're going to be looking at inflation, they're going to be looking at employment, they're going to be looking at consumer sentiment. Are consumers out spending their money? Are businesses employing? How are things going? How far can they tighten monetary policy to bring inflation down without ruining the economy, essentially? And back to currency, the higher the interest rate goes, the more appealing the domestic currency is because of the increased yield potential. So I'll come on to that in a second. So at the moment, we've got this strong labour market. Unemployment is around about record lows, just coming off of record lows. And inflation is persisting. So that will encourage the central bank to raise higher. So what I was talking about. So if interest rates continue to rise and GDP, economic performance, persists at this kind of flat level, which is basically what's expected, then we've got this horrible term stagflation, which is what a lot of people are talking about, where the economy is treading water effectively, but monetary policy is getting tighter, more tough to do business. It's a really negative thing. So that's something to watch out for. And that's broadly expected. That's the point that I want to make here, is that this is what the expectation is at the moment for the future. So the global economy, of course, everybody impacts everyone, particularly the US. So the world's largest economy is the US, and China is the second world's largest. Quite a lot going on in both worlds at the moment. So we've got the US Federal Reserve. They have been exceptionally aggressive with interest rate hikes. Their inflation was a little bit higher than ours, but they have been exceptionally aggressive with monetary policy, raising interest rates, and the dollar has gained to kind of record highs, basically. And that's for a number of different reasons as well, but predominantly Fed aggressiveness. There is this prospect of American recession coming at the back end, Q3, Q4 this year, and whether the Fed are then going to start chopping interest rates, which would allow other countries to gain appeal as well, and other currencies, I should stress. We've had this issue as well with supply line problems. So over the pandemic, the last couple of years, it's been well reported. There's been issues with getting products in because there weren't people working at ports. Factories weren't active or as active as they had been. So we've had this long-going supply line issue that is still going on today, and that was an issue that was increased by Chinese lockdowns, which have until very, very recently continued. And that again is an inflationary issue. If you've got less products coming in, less available products, the price of said products goes up because demand stays the same, but the supply is lower. Supply-demand economics, right? We've also got this very interesting relationship issue between China and the US that's lingering on. It goes back to the Trump days, particularly, and talks of tariffs between the two world's largest economies is just bad for everybody other than the US, believe it or not, particularly the dollar. So yeah, that's an interesting one. Headlines over the last little while have been quite inflammatory. We'll see how that one turns out. Obviously, you'd have seen the balloons and the other stuff that's been going on. Very interesting. And the Europeans as well. So those over the last couple of years, since the outbreak of fighting in Ukraine, of course, the Europeans have been somewhat vulnerable to Russian gas and the supply of Russian gas. And there was this thing going into winter of last year that the Russians may well turn off the gas supply, which would be devastating for mainland Europe. Because they would have to source their gas from elsewhere. Now, that has a knock-on impact as well, because if the Europeans go out to international markets to source their gas, it pushes up the price quite dramatically. So that would have, particularly for the UK, quite a dramatic impact. And again, inflationary issues there. I think, I mean, I don't know what everybody thinks, but I hope that there will be a resolution to this Ukraine conflict in the coming months, hopefully before the end of the year, but we'll see. But yeah, there's this lingering issue, and it's one to consider. So what about the pound? So the pound remains largely on the back foot. So we've got a very aggressive Federal Reserve. The European Central Bank as well have been particularly hawkish over the last quarter or two. In other words, they are insistent on raising their benchmark interest rates. They've been quite slow to the party compared to the Fed and the Bank of England, but now they're making signals that they're going to hike quite aggressively. We'll see how that turns out. But that's put the pound on the back foot because investors have broadly favoured the US dollar and the euro over the last little while. Again, comes down to the perception that there's going to be higher interest rates, higher yield. But the pound has sort of done quite well against the more risk-sensitive currencies. So while all of this horrible global economy and all of the fighting and horrible stuff that's been going on, what happens is financial markets or financial market participants look for havens. They look for somewhere safe to keep their money while all this uncertainty is going on. And so, yeah, you've seen an influx into the dollar and the Swiss franc, stuff like that. But people have come out of more risk-sensitive currencies like, I'll show you in a second, like SEK, well, rubles had a torrid time. But yeah, so the pound's been up against the more risk-sensitive currencies, but broadly, it's so low, and I'm going to show you in a moment how I believe that this is a fantastic opportunity for international investors because on a wide scale, the pound is an exceptional purchase at the moment, or it looks like it to me. So yeah, and what I've hopefully kind of stressed to you throughout is that the predictions for the UK have been fairly negative. We've seen some positive data over the last couple of months. But there's a lot of doom and gloom around the UK, and with financial markets, the biggest move will come from a difference between expectation. We think there's going to be a massive recession and reality. So if the data comes out and we avoid recession and we start growing quite strongly, and inflation falls and all the rest of it, then there will be a big difference between the current pricing for the pound and for other financial instruments and reality. So we'll see a reaction, and quite a large one potentially. So that's why I think that this is quite a good time to be buying into the pound, because it might look terrible at the moment, but that's usually quite a good sign if you're a buyer. But yeah. So what we're following moving forwards, and some pointers for you guys to sort of to monitor. Again, main one, central banks around the world. What are they going to do? Are they going to hike interest rates? Are they going to reduce their balance sheets? Are they going to cut interest rates at some point this year? That's expected from most, because it's not productive. It's not a good thing to have interest rates so high. They will start coming down. Expectation is potentially for the end of this year. I think most likely, I think inflation, particularly in the US, will prove a little bit more sticky than previously thought. And I don't necessarily think they're going to start cutting at the end of this year, but we'll see. Again, monitoring the data. And the data that is going to lead to this is the inflation, unemployment, wage growth, consumer confidence, and retail sales. Those are the kind of main four indicators that have the biggest implication on the central banks. And so they're the things to look out for. And again, as well, less easy to predict by their very nature, but political developments as well around the world. If there are tariffs thrown at the Chinese, I saw the US have called on their allies to raise a load of tariffs on China in the coming weeks. See how that goes. That would be quite bad for everybody. And Brexit as well. Let's see how this Brexit deal goes through. Could well be rejected. We'll see. Again, the details are quite few and far between still at the moment. So, but we'll hopefully get an answer on that in the coming weeks. Yeah. So, Right, I thought I'd finish with just a load of currency pairs. So all of these charts are going back to the 90s, and for those of you who don't have an experience with currency exchange, you want the the exchange rate to be as low as possible when you're selling. This is how much does £1 buy? How many dollars does £1 buy? So in this case, £1 buys $1.4, or at the moment around about 1.2. So if you were selling dollars, you want to sell as few dollars to buy a pound as possible, right? So selling at 1.2 is much more favorable than, say, 2 to 1. Okay. So again, this is where we are. This is where the pound's been over the last little while, turn of the year. Really, really, really on the back foot, again, with all this negativity priced in. So that's sterling dollar, sterling euro. So we've been, and if I go back as well, actually, what you'll see here. So I hope you can see my cursor, but if not, if you go to the middle of about 2016, so this was Brexit. So this was when we chose to leave the EU, and the pound's been largely on the back foot, and thus far unable to break above this Brexit level, this post-Brexit level, let's say. Okay, and again, that's in part due to this ongoing uncertainty over Northern Ireland and how well we're going to come out of the new arrangements. So in theory, get a resolution. We could see some upside. It could provide some potential to, perhaps not go here where we are at the moment, but I think it would alleviate this cap potentially moving forward. So one to watch. Sterling euro. So again, I'm going to fly through these because I know they're not relevant for everybody, but I just want to give you a sort of general impression. Sterling Aussie, again, really, really on the back foot. Sterling Swissy. Swissy is particularly strong at the moment. That's one of those haven currencies. So really boosted of late. Sterling New Zealand dollar, again, right down in the doldrums. Sterling SEK, not so good because slightly more risk sensitive. So it's a little bit not as low as it potentially could have been, or it's others. And sterling Hong Kong dollar as well, again right down there. And so again, just bear in mind, this is the pound is priced where it is because of the common perception of where the future path is of the UK. If there is a difference between reality, we would expect this pound to rise quite significantly. So again, I do expect this to be quite a good opportunity. And that's about it. So thanks for listening. And does anybody have any questions?
What's the football score?
Apologies. I don't know where that came from. That was a bit odd, wasn't it?
Never mind. Okay, brilliant. So we do have a couple of questions. Magnus, actually, Magnus, you met him during mentorship. Hi, Magnus. So Magnus is just asking a question around inflation and what it would be if you're excluding energy prices.
Interesting.
Good question, by the way.
Yeah, interesting. Well, I don't know. The honest answer is I don't know the figure. I wouldn't be able to isolate the figure because it's all factored in. So that's a question for someone much cleverer than I am. Look, the reality is though, I think, Hayley, you'll know as well. In the UK, energy bills have gone through the roof. It's doubled, more than doubled. Would you say?
Yeah.
More than doubled.
More than.
So yeah. And if you say that energy bills make up what 20, I'm pulling figures a bit out of thin air here, but what 20% of your household expenditure, something like that. So it's going to be a significant impact. It's going to have impacted significantly on inflation, but I wouldn't be able to give you an exact figure. But it's an interesting point.
Yeah. Magnus, I'm going to look into that because it's actually really is an interesting question, isn't it? And you
Yeah,
know what we're like with it, we're data
yeah.
freaks.
I can.
It is all factored in. However,
Mm,
just on you know your normal weekly shop and the prices are significantly higher. If you're excluding energy prices, are we excluding fuel as well?
mm,
Because of course that's also had an impact, hasn't it?
mhm.
Because fuel prices have gone up.
I,
So I'm going to look into that, and I'll give you actual statistics and figures
mm.
on the next show.
Yeah, sounds good.
Yeah,
I will say as well, I know that we had grocery inflation out reported at the
yeah,
highest ever, which was over 17% year on year. So gross,
yeah,
your carrots and potatoes and stuff. So yeah.
yeah. Yeah. I mean, your normal shopping basket, isn't it? That's what it
Mm,
should really be.
mhm,
Measured on. However, rent is rising. Everything is costing more money now, so it all has a knock-on effect, and it's all kind of combined at the moment. Time to show that you're actually but however, to look at it in isolation, yeah, somehow I'll get on to that, Magnus, and I'll share on the next show. Brilliant. Okay, I think that's the only question actually. You stunned everyone. Either that or they're all UK. And
Stunned into silence.
they
Yeah.
don't really want to know about currency.
No,
No, we've got quite a few internationals on the call, I can see.
yeah.
I think we've got Hong Kong, Sweden. We have got UK, of course. We've got quite a
Florida.
few Sweden. We've got Florida, Australia. Singapore. So yeah, we've got quite a few. I think yeah. I think that's it. I can't go through everyone. Brilliant. Okay, so if we don't have any questions, I'm going to stop sharing your slides and pop my slides back up. But I'm going to say thank you so much. It was brilliant. I wrote loads of stuff down as usual. I'm going to get on with that later and also check out a few extra things as well. But it'd be interesting now for me to share with the viewers the housing market kind of point of view as well. So I'm going to jump into the rest of this. You're welcome to stay. You can jump off if you're busy. I know you are, but it's entirely up to you.
No, thank you very much for having me, though, and pleasure as always. And thank you to everyone for listening and putting up with me for half an hour of rambling. So, yeah, wish you all a lovely day.
Brilliant. Thanks, Nick. Take care. Enjoy your Friday.
Hayley.
Bye.
You too. All the best. Bye-bye. Bye.
So, Nick, of course, was our special guest. So before I actually jump into the market update for this month, I've got some exciting news. If you've actually been watching any of my social media channels, I'm one of the new angels on the hit Sky TV show Property Elevator, which is kind of like the Dragon's Den for property developers and investors, where we sit, or I will sit with a panel of I'm one of six, with Nicholas Woolwork, Scott Marshall, Ranjan, John Howard, many of you know, and of course Paul Mahoney as well. So the show's really all about you guys pitching your deals and we will fund them. So if you have a deal and you would like to appear either on the live show, which is on the 14th of March in London, where you will pitch to an auditorium of around 300 people, and it's a wonderful show to attend if you are interested in property, which hopefully you are, otherwise I'd beg to differ. Why are you watching this show anyway? But if you're interested in property and you're looking to get into property, or you're an expert and you want to kind of just build off your expertise, this is a great show for you to attend regardless. So it's the Landlord Investor Show at Old Billingsgate. You can register for free and it's on the 14th of March. If you would like to pitch a deal that you either you're looking to buy, you've negotiated, or perhaps you've already purchased and you're looking for funds or support to actually move you to the next step of that development or the process, then come and pitch on the show. And it's also, of course, going to be on Sky, so there will be 2 different pitches. So you can either do that live in front of an audience, or if you'd rather do it in front of a camera, we will be filming on the 21st, 22nd and 23rd of March, again in London, in the Docklands Museum. And again, if you have a deal that you want funded and you'd like to come and pitch it to the panel of angels, then you can visit the link on the website now, and we'll see you on the show. I'm really excited. It's great for me because I've never really done joint ventures. I've always kind of worked with my husband Paul, and he's been my only kind of joint venture partner throughout the 20 years that we've been in property. So it's a new experience for me to invest my money as a joint venture partner. I've been an angel, many of you may know, so I do put my money with investors that have good solid deals and get a great interest rate from them, and they deliver every single time, which is fantastic. So I have been an angel before, but never on a show, and I've never had a joint venture partner. So I'm actually really excited to see what the show can bring. I'm looking forward to putting my money into some exciting deals that are outside of kind of me, and also investing in what will hopefully be future partnerships as well. So if you're interested, apply to be on the show, either live or in front of a camera, and I'll hopefully be funding some of your deals. So I look forward to seeing you on the show. So I'm going to jump onto my market update now. I'm going to jump off camera. I'm doing it a little bit different because I'm kind of picking up data as we go along today. I had a planning application declined, so I actually when I normally write at home with Hayley and pick up all of the data, I was actually on site with conservation officer and planning consultants and planning officer to try and discover how we can get around this planning refusal that we had. So I'm going to do it off the cuff today, and hopefully I deliver. If not, you can forgive me. It is 59, 1 out of 59 won't be too bad, will it? So I'm going to jump off camera and jump across to some data that I've picked up. And if you do have any questions along the way, thank you, Magnus, for your congratulations as well on the show. As I said, really looking forward to it. So I'm going to jump off camera now, and bear with me. So I thought it'd be a good idea to kind of look at, because Nick's done such a good update in terms of the state of the economy, employment and all things like that, which is all important and all has an impact on what I'm going to talk to you about now as well, because it's actually all connected, however different it is. It's all has that connection of which we need to be aware of. So 3 years on then, so how has the pandemic reshaped the UK housing market? It's a big question, isn't it? Let me know your thoughts in the chat box. I'd be interested to find out your views, how you've been affected. Has it stopped you from buying? Have you purchased more? Have you changed your strategy? How has lending affected you? So it'd be really great to kind of hear your views in the chat box on how you think the pandemic has reshaped the UK housing market. So I'm going to be taking, I'm going to take write-ups from different data sources. So House Price Index, Halifax, Zoopla, Inside Conveyancing, and a few more. So we're going to have a mixed bag of different views, I think, here. So we have seen price drops linked to the financial market turbulence, which happened in response to the mini budget at the end of September last year. Before this, mortgage rates were already rising last year as the Bank of England put up interest rates to tackle the soaring costs of living. Some lenders have started reducing fixed rates to show below 4% for the first time since the mini budget. But this is still far higher than levels seen in late 2021. The lingering impact on confidence, as well as the ongoing impact of financial pressures that have been weighing on households for some time now, is starting to show in the decline and affordability and lack of confidence, resulting in the market, in my opinion, starting to change and become more of a buyer's market and a bargaining tool. It's important to take all of this into context, so I'll share some stats with you so you can get a better understanding of what this actually means. So annual house price inflation slowed to 5.3%, down from 8.6% last year. Buyers' demand and sales volumes are 20 to 50% lower than a year ago. So that's sales volumes and demand has dropped, but still ahead of the pre-pandemic years of 2017 and 2019, which is your more normal market conditions. Sellers are having now to accept an average of around 4.5% discount to achieve a sale on their properties. And sales are, of course, taking longer as well, and in line again with more normal market conditions of around the 60 days. Market is still on track for a soft landing with a modest price fall of up to around 5%. So if we look at the kind of glass half full or glass half empty analogy, so housing market activity has rebounded in line with pre-pandemic levels, which shows the correction in the marketplace, of which we've spoken many times before throughout the last 2 years. It is impossible, sorry, not impossible, it is possible to, however, take two opposing views on the performance in the sales market in this current moment in time. And so if we look at the glass half empty view and we go down the negative route kind of first of all, so the glass half empty view is to look at trends year on year and comparing this year to the red hot market conditions a year ago, which is, you know, it was a feeding frenzy. There's a sheer lack of supply. House prices were going up to ridiculous levels, and there was a real kind of surge in the market. So the red hot market conditions that we saw a year ago perhaps isn't fair for us to kind of compare. However, it is a statistic that we need to take into account. The glass half full view so compares the current market to the pre-pandemic years, so more normal market conditions of around the 2017 to 2019, when activity levels and house price growth were more benign and trading conditions were tougher. So year-on-year comparisons are important for business benchmarking, how they are faring compared to last year. Our data shows demand from home buyers has rebounded in the first 2 months of 2023, but remains at half the level recorded a year ago. New sales volumes in 2023 or early 2023 have also recovered, tracking the usual seasonal upturn we see each year, albeit lower than this time last year, of which again we've spoken about. Everybody talks about, oh, there's been a decline in demand, or there's been a decline in this, or house inflation has slowed. But in actual fact, if you look at seasonal trends, it is in line and more normal market conditions, and of course lower than last year, but last year was a red hot market. The reality is current market conditions are more aligned with the pre-pandemic years, with demand 8% higher and sales agreed up 1%. This is more useful or a more useful benchmark for businesses to plan strategies and investment decisions now that the thriving market conditions of the pandemic years are behind us. So activity levels are holding up in more affordable markets. There's no surprise there. So more affordable housing markets such as the North East and Scotland are ahead of the pre-pandemic years. This is because higher mortgage rates have less of an impact on demand in lower value markets. Sales are 4% above their pre-pandemic 2020 levels in London. Far from being an affordable market, house price and market activity have significantly underperformed the rest of the country since 2016. This makes the capital appear better value for money, which is supporting sales at this moment in time. Excuse me. The latest data from valuation and risk business HomeTrack shows that the discount to achieve a sale has increased over the last 5 months and currently stands at around the 4.5% mark, an average of around £14,000 discount per sale. So if we put this discount into context, the average UK home grew in value by around £42,000 over the pandemic period. There's been a 20% hit to buying power since the 4% mortgage rates came in, compared to the 2% mortgage rates we saw a year ago. The transition to a buyer's market has begun as the market adjusts to the reduction in buying power resulting from higher mortgage rates, which is, it always has a knock-on effect. Buying power is starting to recover, though, as mortgage rates fall from their 6% highs of late 2022. But even at 4% mortgage rates, the average home buyer has 20% less buying power than they did a year ago, when mortgage rates were, of course, around the 2% mark. This will not feed straight through into house prices, however. Some buyers will look to buy smaller, cheaper homes, as we highlighted last month. Others may inject more equity into purchases or be in a position to spend more money on mortgage repayments. So we will kind of see a flow and a change in the market as this does have a knock-on effect. And of course, now that mortgage interest rates appear to be coming down, and I do think that, we had David on last month and we were talking about, well, will it come down or not? But we actually saw that they've already started to come down, and there is a bit of a price war. And of course, if you look at lenders, they are in the business to lend. They are a business, and they're only making money when they are lending. So there has been, I think, a little bit of a price war, and we are seeing some really competitive rates come out of what was an awful kind of reaction to the mini budget earlier on. So data has started to pick up the decline in agreed prices over the last few months. We expect data to continue to show small month-on-month price reductions over the next 2 to 4 months as well, while the market softly resets and finds itself. The summer, we anticipate annual price reductions of around the 2 or 3% mark. So if we look at regional and city house price index, so this is sourced from Zoopla, we can see an annual price change in house prices as well. So if we look at cities and the annual price, the annual change or percentage in house prices, we had Nottingham up at 7.8%, Birmingham at 7.4%, Leicester at 7.3%, Manchester at 6.9%, Cardiff and Liverpool at 6.5%, Portsmouth at 2%, Sheffield at 6%, Leeds at 6%, Bristol at 5.5%, and Newcastle matching that at 5.5 as well. Bournemouth at 5%, Southampton at 4.9%, Belfast at 4%, Cambridge at 3.2%, Edinburgh at 3.1%, Oxford at 2.8%, Glasgow at 2.7%, and Aberdeen right there at the bottom at 0.2%. So that's from your city point of view. So the annual percentage change in house prices as an average across the UK would be the 5.3% mark. So let's look at the growth. So that's the area. So let's look at the growth by property type, because this is super important. It's interesting really to drill down into the different property types and their performance. So larger homes, for example, detached properties, let's look at those first. So heading into the pandemic, the rate of annual house price inflation for detached properties was relatively sluggish compared to other property types at the 1.7% in January 2020 versus the 4.1% for flats, with buyers perhaps willing to or less willing to pay a premium price at that moment in time. Fast forward just a few months though, and everything changed. Suddenly there was a surge in demand for larger homes. This was driven by a number of things, but was down to the race for space as buyers sought bigger properties, often in more rural areas as well. This was in response to the changes in people's lifestyle and working habits brought on by lockdown. By the start of 2021, annual growth for detached homes had jumped to plus 9.2%. Fueled further by cuts to stamp duty across the UK, the average price of a detached home rose by a 25.9% between the start of 2020 and the end of 2022. That's massive for over a period of 2 years. This compares to just 8.8% in the 3 years prior, if we look at the more normal market conditions of around January 2017 to December 2019. Looking at the pace of growth, Wales saw the strongest house price inflation for detached houses over the last 3 years, up by around a third at a whopping 33.8%. So if you were flipping detached houses in Wales or you held detached houses in Wales, the value went up massively. In cash terms, in cash terms, 5 UK regions. So if we look at Eastern England, Greater London, South East, South West and the West Midlands, saw the average price of a detached property rise by more than £100,000. So if we look at flats by contrast, demand for smaller properties in urban areas fell during the pandemic. At a UK level, the average price of a flat increased by plus 13.3% between the start of 2020 and the end of 2022. However, the capital saw the average price of its flats grow by just 3.8%, even with expensive starting points at around the £361,000 mark, and that's January statistics of 2020. That translates to just under £10,000 increase in the capital. That's the weakest price rise of any property type across all regions and nations over the last 3 years. Compare this then to the northwest of England, where prices for flats still managed to jump by 24,000 or just over at a 23.5% over the same period. Semi-detached and terraced houses, we'll throw those together. So semi-detached and terraced houses saw their average value increase by 23.1%, and that equates to around the £55,000 mark. Increase. Greater London saw the biggest increase in cash terms, up by £90,000 for a semi-detached and £69,000 for a terraced home. But in percentage terms, these were among the smallest increases for these property types across the whole of the UK, again at only a plus of 15.8% over the same period. In terms of the strongest rate of growth since the start of 2020 for semi-detached houses, this came in the southwest at 30.8%, followed by Wales at 28.4%. For detached homes, it was the northeast at 32.1%, and then the northwest of England at 29.8%. So it's important to identify what property types work in your chosen area of investment, because they all tell a very different story. And it's also important to understand what doesn't work as well. There are micro markets throughout the whole of the UK. We can never look at averages or just look at a town or a city. We really do need to drill down to the performance of our geographical area and make sure that we are area experts. All areas are different and have different factors driving each market. Area and opportunity. So you need to be aware of what works in your areas, where the demand comes from, how strong is it, so what's driving it, what's the current supply, what's the population, the density, the affordability, the employment levels, the visitor statistics, the growth over the last 15 years, rental yields as well, both on residential and commercial. It's up to you to become the expert within your chosen area of investment. And I can't stress that enough. Many of you know me as a research freak, and I absolutely am. I love data. I love research. Now, do I know absolutely every area of the UK? I researched every area of the UK about 15 years ago, but I choose the areas I invest now and watch other areas. And I'm constantly always looking at different areas, looking at different strategies, looking at different angles. And the reason I do that is because I don't like to put myself in a box. I like to be flexible. I like to look at everything with an open view. I don't wear blinkers, despite the fact I might have a chosen strategy in an area. I don't only look at that strategy. I look at the overall market and let that and the demand and the current supply drive what strategy I end up doing in that area or change to. Our investments are ever changing. So throughout the pandemic and where the prices were high and the market was hot, I sold quite a few of my properties in Liverpool, for example. And I repurposed some other properties as well to make better investments. So we're always looking at an ongoing market, ongoing demand, ongoing strategy. Does it work? What's the key indicators? What's the performance of that asset? And do we need to switch or change to make it improve and be a better asset within our portfolio? So hopefully that update, I'm not going to go on for too much longer because we are at the hour mark, but hopefully that update was useful. It was kind of a broad update, hopefully complementing as well Nick's in-depth update with the UK economy and where it sits right now. If you do have any questions, pop them in the chat box. I'm going to just pop along and let you know about a few events that we've got coming up. So we have the Property Success Convention coming up in might be March. I should have this date. It's normally on the slide. It's not on there. However, if you scan the QR code, we're getting technical these days, it will take you through to the landing page for the Property Success Convention. It is free for you to register, and it's a one-day event. And we talk all things property. So we'll be going through different strategies, what works right now, how to identify areas of investment, how to analyze those areas, how to run the numbers, what numbers are important, the people you need within your team, and everything else as well. So if you'd like to come along and you'd like to jump on the Success Convention and share a day with myself, Paul and the YFE team, we can do this live in person. So we will have a live class held at our training facility in the north of Birmingham in Dudley at the YFE headquarters, and we will also live stream as well for those of you that are international. So scan the QR code on screen or pop along to our website and have a look at the Property Success Convention. Hopefully we'll see you on the next one. Of course, you can. I actually haven't been on Property TV for Property Question Time. Sorry, I'm on Property TV, but I haven't done a panel for a couple of months now. But you can watch the. I will be. I've just been super busy with loads of projects on and absolutely no time to get into the studio. But if you'd like to watch any of the replays or any of the other guests, I mean, it's a phenomenal show. It has some wonderful guests on there. It's great to get different views as well. There's some fantastic panelists, and there's always great questions. The show's on a Tuesday and a Thursday at between 8 and 9 on channel 186. And so if you'd like to watch, pop along and you can watch that on Sky. If you don't have Sky, you can watch the live stream on YouTube through Your Freedom Empire as well. And any of the shows that I've appeared in are also on our YouTube channel, Your Freedom Empire. And then, of course, and use this as well. So this is a free consultation call. I've had calls with many of you that are on this morning. I recognize many of your names. But this is a free consultation with a mentor. It can be with myself or it can be with one of the other mentors within Your Freedom Empire. You can book a 3, no obligation, no sales, really to discuss your situation, any questions that you might have. And I'd encourage you as well, if you're looking to get onto the property elevator and you have a deal but you're not quite sure about it and you want to talk it through, just book a call. If you don't want to book a call but you'd like to send something through to me, to perhaps for me to have a look at prior to actually applying for the show, I'd be more than happy to have a look through it for you as well. You can pop an email to admin@yourfreedomempire.co.uk and just pop in the chat the subject box property elevator question. And I'll go through any information with you that you require. I'll have a look at what deals you're looking to put forward. I'll give you my opinion and of course, help you with putting that pack together to appear on the show. So I'm going to jump off this one now. If you do want to book just a general consultation call in, we've had loads and loads recently. I mean, they've always been really popular, but I tend to be constantly on calls at the moment, which is great. Fantastic. I've spoken to some really great people and made some really good contacts as well through that consultation period, and actually some of you are coming through our training also as well, and we've been able to help you solve some of the problems and struggles that you're working with at this moment in time. So it's an absolute pleasure. So please don't think I'm complaining. Feel free to book those calls in. So I'm going to say that's it. It's Friday. It's fun day. I'm going to sit down with a glass of wine this evening and chill with my family and get ready for what's a very busy week next week. But I'm going to say to you, have a wonderful month. Stay positive, stay focused, hold yourself accountable and make it happen. And I'm going to love you and leave you. And I'll see you for our 60th show on the first week of May. I look forward to seeing you all then. Goodbye for now.